Hi folks, welcome back to Mukti Finance Academy. Today we will be discussing one important player from the solar sector is Vikram Solar Limited. But before we start, a quick disclaimer: I am not a SEBI registered analyst. Whatever the companies we are going to discuss are purely for educational purpose. Now let us start. So Vikram Solar Limited delivered a breakout Q3 fiscal year 2026 with revenue growing 8% year on year to 106 crores, 1,106 crores, while EBITDA and PAT surged by staggering 142% and 416% respectively. Operationally, the firm achieved a 90% effective capacity utilization and expanded its order book to 10.6 gigawatt, representing over one times its current rated capacity. The real question: can Vikram Solar scale its massive 4,371 crore BESS Foray without compromising its industry leading 0.08 times debt to equity lean machine? So Vikram Solar occupies a critical yet often underestimated position in India's renewable energy value chain as one of the nation's largest pure play solar photovoltaic PV module manufacturers. While domestic utility scale peers often struggle with bankability requirements of international leaders, Vikram Solar differentiates itself through 20 years of execution history and 8 consecutive quarters as Bloomberg NEF Tier 1 manufacturer. This status is the primary catalyst for its made in India for the world export strategy and its ability to lock in long term contracts with global independent power producers. However, the company is now moving beyond its legacy as a module assembler, pivoting toward a fully backward integrated cell and storage model to capture the higher margins currently leaking to the global supply chain. So the company incorporated in 2005 and headquartered in Kolkata, Vikram Solar operates a sophisticated business model across solar module manufacturing, engineering, procurement and construction, and operations and maintenance. As of December 2025, the company commands a 9.5 gigawatt manufacturing capacity across its Falta in West Bengal and Tamil Nadu, Oragadam, and Vallam facilities. The firm exhibits a high equality return profile with a ROCE of 26.4% and ROE of 16.6%, metrics that stand out in a capital intensive sector. So, Vikram Solar's competitive edge is built on a track record of 9.46 gigawatt modules sold since inception, providing a reliability dataset that new entrants cannot replicate. This execution mode is validated by its eighth appearance on the Kiva PVL Reliability Scorecard as top performer. Furthermore, its NABL ILAC MRA accredited laboratory enables its in-house standard setting for sampling and calibration, creating a technical barrier that satisfies the stringent due diligence of utility scale financiers. So the investment thesis for Vikram Solar is shifting from a volume-based assembly play to an efficiency arbitrage strategy. The company is weaponizing its 10.6 gigawatt order book to force a transition to high efficiency N-type modules, specifically the Hypersol Pro, which delivers efficiencies up to 23.69%. As ALMM 2 mandates higher efficiency thresholds for fiscal 2027, legacy PERC systems, which are peaking at 23%, are facing an impending obsolescence cycle. Vikram Solar's move toward 12 gigawatt of integrated cell capacity allows it to capture the margin expansion from cell to module integration while providing the high yield products IPPs required to meet aggressive new Ministry of Power mandates. The market is currently missing the scale of this replacement cycle. Vikram Solar isn't just adding capacity, it's high grading the entire industry's technology floor. So the strategic tailwinds provided by the MNRE have evolved from policy incentives to mandatory consumption obligations, fundamentally de-risking the demand side for tier 1 manufacturers. So TAM and targets, if you see, India's ground mounted solar potential is 3,343 gigawatt. National installation targets have been revised to 323 gigawatts by fiscal year 30, necessitating an annual addition of 40 to 50 gigawatts. And coming to regulatory compulsion, the Ministry of Power's Renewable Consumption Obligations RCO mandates a raise from 29.91% in fiscal year 2025 to 43.33% by fiscal year 30. So Vikram Solar 73% IPP order book concentration makes it the direct beneficiary of these mandates, as IPPs are the primary entities forced to meet these targets. Coming to the BESS opportunity, its grid intermittency is driving a 250 plus gigawatt energy storage demand by fiscal year 30. CERC's draft framework for integrated ESS now recognizes storage as a regulated asset, paving the way for Vikram Solar's pivot into integrated solutions. So its utility segment, which is nearly 73% of the order book, this is the volume driven engine where bankability and scale are the only ways to defend margins against competitive bidding. Coming to its commercial and industrial, which is around 10% of the order book, this segment acts as margin accretive buffer, serving high yield corporate rooftop and captive power requirements. Coming to exports, which is 16% of the 9 months fiscal year 2026 mix, a strategic hedge against domestic pricing volatility, leveraging the FEOC compliant supply chain demand in the US and EU. Coming to its BESS plan, its 4,371 crore phase 1 of 5 gigawatt hour foray is the future margin engine intended to transform Vikram Solar from a component seller into a systems integrator with significantly stickier revenue. The Q3 fiscal year 2026 results highlight a massive divergence between revenue growth and EBITDA growth, signaling a transition to higher value products and improved operating leverage. Its revenue for 9 months fiscal year 2026 run rate reached 3,349 crores, with Q3 volume sold jumping to 796 megawatt versus 590 megawatt year on year. Coming to margins, its EBITDA margins expanded to 19%, up from 8% in Q3 fiscal year 2025. The path to steady state 20% plus margins is paved by the phase out legacy PERC and the integration of N-type cell capacity. Coming to its balance sheet, the current 0.08 times debt to equity ratio is exceptional but will be tested. Total planned investment across cell, module, and BESS expansion now exceeds 10,700 crore. In this, 6,385 crores for cell and module and 4,371 crore is for BESS. Coming to its earnings trajectory, its EPS surged to 2.7 year on year, supported by a 58% TTM profit growth. So, coming to as a summary, what we can see is Vikram Solar is weaponizing its clean balance sheet to swallow the storage market before debt's cost rise. The recent India ratings upgrade to IND A plus stable is a formal stamp to institutional approval, signaling that Vikram Solar has the dry powder necessary to fund its massive 10,700 crore plus capex cycle without over leveraging. So the company in its management con call highlighted that it appointed Mr. Arun Mittal as CEO of VSL Power Hive. It shows that hiring a dedicated CEO for the BESS subsidiary signals that management views storage not as a sidecar but as a primary growth engine. And the board also approved 4,371 crore capex for entry into BESS phase 1. It shows a high conviction bet on the integrated ESS regulatory shift. It represents a bold move to own the brain of the solar plant. Coming to its 15-watt gigawatt expansion, commenced operations at our 5 gigawatt module plant in Vallam. It shows that scaling from 2.5 gigawatt in fiscal year 2023 to 9.5 gigawatt in late 2025 proves management is over delivering on capacity timelines. Coming to its launched Hypersol Pro and which is having high efficiency up to 23.69%. So here Vikram Solar is utilizing robotic automation. The lack of explicit AI-driven yield optimization is a competitive gap that could risk its long-term O&M margins. O&M is nothing but operations and maintenance margins. Now it's commissioning of new module lines, which is planned in Q1 fiscal year 2027. It shows that Vikram Solar is timing its capacity to hit exactly when ALMM2 efficiency mandates delist low tier competitors. So Q3 shows module substructure civil activities are completed. However, Q1 fiscal year 2027 commissioning timeline allows very little room for equipment delivery delays. So coming to its order book, it is at around 10.6 gigawatt, provides multi-year revenue visibility, and capacity utilization is at around 90% effective CUF, indicating peak operational efficiency. And coming to its debtor days, it got reduced from 172 to 131 days. So this 41-day reduction is critical. It unlocks significant working capital to fund the equity portion of the Vallam and cell expansion projects. And its inventory days is also around at 61 days and ROCE at 26.4%. So coming to valuation, so the Vikram Solar is currently trading at a PE of nearly 14 times with a market cap of nearly 6,310 crores. Given that trailing 12 months profit growth of 58%, the valuation appears decoupled from the underlying growth rate. In a bear case scenario, if there is a technical delays in the 4,371 crore BES ramp up or a slowdown in utility scale auctions leads to multiple contractions as the debt to equity ratio claims. In a base case scenario, if timely 5 gigawatt Vallam integration and 19% EBITDA sustainment supports the current valuation. In a bull case scenario, if it is successfully front-running ALMM-II mandates and completing the 12 gigawatt cell integration results in a re-rating to premium integrated player multiples, which typically command a 2 times premium over pure play assemblers. So at 13.9 times PE, against nearly 60% profit growth, the stock looks cheap. The margin is pricing Vikram Solar as a low margin manufacturer, ignoring its transformation into a high margin integrated energy proxy. So some key red flags which I have noticed is promoters have pledged 48.2% of their holding. This creates a mechanistic risk where stock volatility could trigger margin calls. And coming to second risk is concentration risk. 73% of the order book is tied to IPPs. Vikram Solar is highly sensitive to the piece of utility scale government auctions. And the third is governance or holding. A 30.1% decrease in promoter holding over 3 years requires monitoring to ensure long-term management alignment. And the fourth risk is capex execution. The 4,371 crore BESS Foray represents 70% of the current market cap. Any execution failure here would be a catastrophic blow to the balance sheet. So some key monitorables which we need to track are its full operational status of the Vallam plant by Q1 fiscal year 2027, first sell out milestone by December 2026, BESS phase 1 equipment ordering and capex utilization, any reduction in the 48.2% promoter pledge, sustainment of debtor days below 131, and finalization of ALMM-II efficiency threshold mandates. So Vikram Solar has successfully evolved from a local module assembler into a vertically integrated energy storage and generation proxy. Its lean balance sheet at 0.08 times of debt to equity and IND A plus stable rating provides a rare safety first entry into the high volatility solar sector. While the 48.2% promoter pledge remains a shadow, the operational core 90% CUF and 10.6 gigawatt order book is firing on all cylinders. The market pays for modules today, but the real upside is the hidden cell and storage play, provided the promoters don't let the pledge clock run out before phase 1 BESS comes online. If you like this video, please do like, share and subscribe to Murthy Finance Academy. Thank you.